everyone, and welcome to our Altos Trading Live Strategy Session with Jeff Tompkins. This is your host, Richard Van Rich, and we're here with Craig Ward in the chat to answer any questions you guys have throughout the evening. We're really excited to have you guys with us here tonight. Got a lot of great stuff to go over. And if this is your first time on here, notice that your microphone is muted. That's so we can all hear Jeff and I talk. But there is a Q&A box at the bottom of your screen. So if you have any questions throughout the evening, put your questions in there, and we'll get to those throughout the process and also at the end before we hop off. And if you do hop off, don't worry, this is recorded and will be available in the members area later tonight and also on YouTube sometime tomorrow. So if you're on YouTube, you want to see more videos, please like and subscribe to our videos. So before I bring on Jeff, let me just read this disclaimer here. Altos Trading and Trade Transilient software is intended to be used as information service for subscribers and includes opinions as to buying, selling, or holding various stocks and other securities. However, the publishers of Altos Trading, Trade Transilient software are not brokers or investment advisors and do not provide investment advice or recommendations directed to any particular subscriber in view of the particular circumstances of any particular person. Altos Trading LLC, including its owners, do not accept responsibility for any decisions made by subscribers using the software, and subscribers to the Trade Transilient software or any other persons who buy, sell, or hold securities should do so with caution and consult with a broker or investment advisor for doing so. So that being said, let me bring on Jeff. Jeff, if you're there.
Hey.
There you go. I like the background, man. Where are you at?
I'm in the office.
You're in the office? It looks very official.
I'm working from home today.
There you go. It's like Elon Musk's house.
Yeah. Speaking of, I heard he's getting sued by Twitter.
Yeah, hard to believe, huh?
Yeah, I saw that one coming.
Yeah, I know. It doesn't seem like a good idea to begin with. Like, he knew there were millions and millions of like bogus bot users. Like, everyone knows that.
Yeah.
Like, what do you expect?
Yeah, I think a lot of it's.
I think he's got a lot of money and he's bored. He's already like, because usually like the end all, crescendo for the rich people is just like to try to build a rocket or something, like fart around in space. But like, he's like, no, let's go ahead and start throwing the market into frenzies with goofy takeover pursuits and stuff. Doesn't make any sense.
Yeah, I didn't check Twitter stock today. Maybe we'll take a look at it.
Yeah.
Not sure.
How's everything else? How's everything going out in Boise?
It's all good here. We're getting the heat wave, 102 today. Brutal.
That's not good. It's been in the 90s here for weeks and weeks. Longer than I can ever imagine. I remember.
You're in hot Atlanta.
Atlanta, I know. So does that affect the fishing out there?
Not really. You just got to get out earlier or fish later.
Yeah. Or drink more beer.
Yeah, exactly. I got my margarita though.
There you
Cheers.
go. Have you been fishing much this year?
Actually, haven't gotten out a whole lot. Been all these projects we have going. It's been a busy year, obviously, as you know. But
yeah. We should do, guys. Everyone out there, we should do like a big event out in Boise and have the members come out and do a big fishing extravaganza.
That'd be fun. Yeah, we're actually. So I'm glad you brought that up. We are going to start. We attend different trade shows. For instance, like the Money Show or International Traders Expo, at different locations. We were just more recently at the Vegas Traders Expo. Was that in February?
February.
So we'll make sure to let you guys know with enough advance notice when we're going to be at a location. Reason being that our intention is to kind of start holding some in-person events so we can meet our members face to face. If you guys are going to be in attendance or would even maybe consider, going to the location, just even if you're not attending the show, to meet with us and do some, education and workshopping and, meet and greet. Basically, we like to meet our members. So we'll keep you posted. Right now, I don't think we have any. Our next events, I think, is planned for Orlando, but that's not till November, right?
Yeah,
October.
It's like over Halloween weekend, I think.
Yeah, we could dress up. Dress up as traders, floor traders. All right. All right, guys. Well, thanks for attending. As Richard mentioned, some really important, valuable things to cover tonight. And it's actually gonna kind of lay the groundwork for next week. And I'll explain why, what we're gonna cover. And ideally, we want, our sessions to build on each other. So as we start to cover some of these kind of higher level overviews of strategy or markets, how we can start using that and drilling down into actionable, whether it's trade strategy or approaches that we can use and that you guys can use in the markets. So that's what we're going to kind of do tonight after we map out our levels and then review the 36-month moving average, which is still very relevant. And we have a couple key levels in the S&P to watch, I would say, especially for tomorrow. Tomorrow, we had a lot of volatility today. Tomorrow is the CPI report, Consumer Price Index, and that's being watched closely because it's going to tell us what the inflation results were for June, which I think the expectation is they're going to go up a little bit from, I think, 8.6 to 8.8%. Don't quote me on that, but I think roughly that's the expectation, which I think we'll have a lot. We'll probably see quite a bit more volatility tomorrow in the markets because of that report, that key report that's coming out. And it could, have a lot of impact over the next, the rest of the trading week and the weeks to come. And so there's two really significant levels on the S&P to watch tomorrow. And interestingly, and not surprisingly, we closed in between those two levels today. So we're going to talk about that. And then what we're going to get into a little bit more detail is VIX skew, VIX, the CBOE Volatility Index, and how we can use that to help us time markets. So we're going to look at two different types of skew: volatility skew and pricing skew. Regardless of whether you're an options trader or you're trading equities or ETFs or not really all that important as it relates to skew. This can be used, although it's an options-based topic, can be used to give us a good indication of future market moves, even if you're, let's say trading equities and not options, even though it's options related. It gives us a lot of good information in terms of how options are pricing in expected moves and whether, and today was a good example, and we'll look at that, but whether on any particular day, the market is telling us, or I should say the VIX and the skew is telling us whether the expectation is, for a move up or move down in the market. So we're going to look at that, and that's going to lead into an actual strategy topic for next Tuesday. And we're going to look at how to use VIX risk reversal trades to, they can be used kind of for two things: for hedging, if you have like a 401k or an IRA that you, have long positions in, or even for speculation to make money. And it's a great strategy and great trade. And we're going to cover that because it's going to take a little bit more time, cover that in more detail next week. But what we learned today will help lay the groundwork for that next week. And then we'll open it up to ticker roundtable.
I like it.
Yeah. It's going to be good stuff. So let's go ahead and look at some of the key levels. Let me turn off my video here to watch here especially for tomorrow. Let's see, get my platform up. I don't know how that got over there. Got too many screens here. All right. So looking at the S&P 500 index, on the close today, 38, 18, and 80. So as we mapped on, I think last week and maybe even the week before, but we've been focusing on this 3,800 support level as the market moved up through that really twice in recent months. June 24th really blew through, and then again earlier this month. And there's some support we want to notate at that 3,800 level. Okay, century mark on the S&P, and in play for tomorrow. So you see the move off that zone back in late May, and there was a big move up off that support zone, which later served as resistance in June. But when we broke through it, it's serving as support. And today, let's see what the actual low on the S&P was, 3802. So it almost came down and precisely touched that century mark today, and then got a little bit of buying intraday and closed us off that low, a little more than 18 points above. So there's also a really significant resistance level, not just technical, but I'll explain here. So 3850 roughly is our resistance. So that's why I mentioned we close kind of in this this significant zone. And as we approach June CPI tomorrow, we want to see how the report and the reaction to it dictates what the S&P is likely to do over the rest of the week and into subsequent weeks. So there's a technical case for this being a strong level. It is a half century mark. And we got a big move off of that level back in May that held for the rest, most of the rest of May. Didn't get a close below it until around mid-June. But the other reason this 3850 zone is very significant resistance is it's right around the 20% peak to trough sell-off. Well, it might be not. I think it's based on this trough. I'd have to recalculate. But regardless, that's not really relevant. What is this level here around 3850 marks the 20% level from the peak of the S&P back late last year. So what is that? Why is that significant? Well, 20% is peak to trough, as we know, is the indicator of bear market conditions. So if we're trading below 20% or below a recent peak in the market, that's what is on a technical basis considered bear market territory. So we close back in bear market territory today, and that's what we're watching as it relates to resistance, because price is now below that, and we're in a technical bear market again. We got out of it a little bit here and here, and we're back down below it with 3,800 as support. So what does this zone mean, and how do we use it for the rest of this week? Well, if the reaction tomorrow to CPI is positive and we close back above this 3850 zone, then I expect we'll get a significant and sustained move up in the S&P. If we get a close, so I'm talking about like closing basis tomorrow, if we get a close below 3,800, then my expectation is a retest of these lows from mid-June, right around 36.25. Let's see, 36.36, 36.39. So they're the closest mark is a quarter century mark around 36.25. So be cautious of false breaks of these levels tomorrow intraday. Again, we'll probably see a lot of volatility tomorrow because of the June CPI report. And we could see a breach of either this resistance or this support, and then a reversal out of it. So it's going to be tricky to trade intraday. But on a closing basis tomorrow, if we see a strong close beyond either level, 38.50 to the upside or 3,800 to the downside, that's, I think, going to be our bigger indicator of future market direction for the rest of this week and even in the coming weeks, depending on the conviction behind that, behind those closes. So really important to watch tomorrow. 3,800 support, 3,850 resistance, and that's going to give us a lot of information. Okay, so that's all I really want to focus on for key levels on the S&P for tomorrow and the rest of this week. Let's take a look at the NASDAQ 100 ETF, the Qs. So we've got some significant support really around 280 that I'm watching. So I want to see 280 hold for bullish indication. And if we get a sustained break on the close, so closing price below 280, then I'm watching 270 for support. And if this 280 level can hold, I'm watching a 290 for resistance and 295 more significantly for resistance. Okay, so similar to the S&P, we are in, this is our SR zone, support resistance zone. So we're kind of in midfield here as it relates to support and resistance on the Qs, like we are on the NASDAQ or on the S&P. And let's see what's happening with the VIX, because this is going to be the focus tonight. Let's close that out. In helping us determine market direction. And we're going to look at how to use volatility skew on the VIX options to tell us kind of give us a picture of what the market is expecting and how to monitor that. And then we'll talk next Tuesday about specific strategy. And there's some really cool strategies we can use for portfolio hedging. So again, like if you have a 401k or an IRA, or even in your personal account, if you've got a long portfolio, maybe you're invested in some like index options like the SPY or the Qs, or you're holding some stocks, this is a great way to hedge. And if when the market goes up, you can still do well because these can be done for relatively minimal risk. And it can also be used as a standalone trade for speculation. So it's really important that we understand, what the skew is as it relates to implied volatility and pricing and what that means. So we had a pop in the VIX today, right? So the VIX closed up over 4%. And we've talked a lot about in past weeks about this 25 level. So that's still holding, right? And we see this year a lot of support around that level, and prior resistance around that level also. And then we've got some VIX resistance in this kind of 29. 29 is kind of the strongest static level, and particularly 30 for the zone. That I think will help us navigate any turning points in the market or continued sell-offs if that happens. 35 to 40 is our strongest resistance zone on the VIX for this year. So that's one to watch as well. So remember, the VIX is a volatility index, and it's pricing in expected moves in volatility, and kind of tells us what the sentiment is in the market, whether there's fear in the market or there's kind of the opposite, exuberance or optimism, where buyers might come in. And so always remember that generally the smart money or institutional buyers and sellers generally buy low and sell high. Unfortunately, most retail traders sell high or buy high and sell low, the opposite of what we want to do, right? So the purpose of this is to help you think more like the smart money or institutional traders, and less like the crowd, which is the bulk of retail traders, and that's what the VIX really helps us do. Is we actually want to look at buying opportunities when the VIX is high, and look at selling opportunities or profit taking when the VIX is low. And so that's why this is important. So it can also help us, gauge the sentiment in the market as we break any of these support or resistance levels on the indices like the S&P. If we see the VIX close below 25, which is our support, and we see the S&P break through a resistance due to the inverse correlation of the two products, then that is what gives us our edge for determining future market direction. So really important. And as we will here in a second, get into VIX pricing and volatility analysis, there's a great way to determine, not just with a chart, but with options data, what the smart money is telling us, whether the expectation is for a move down or a move up in the S&P. And the beauty of options, because they have expirations, it can also do that as it relates to time with a specific time horizon. So we can use this analysis to determine, like, if we want to see, is this week, is the market expecting, a move up? Is there more fear to the downside, or is there more, exuberance to the upside? So that's what we're going to take a look at. And we don't even need to use a chart to do it. We can look at the numbers and get a good indication of that. So those are the levels to watch this week. So I'll pause and see if there are any questions there.
Let's see. Nothing directly to this. Is a general question about differences between the VXX and UVXY. But as far as about your market overview, no questions have come through on that.
Okay, yeah. So the UVXY is the VIX short-term futures ETF. I don't know if we have it loaded into Zillion. Let's see. Yeah. We often get, when we talk about the VIX, we get a lot of questions about other VIX products. And
there's so many of them.
Yeah, there's a lot. And, you know, whether they're good to trade. I like I stick purely to the VIX. You can see that there's, you know, most of these strategies, as far as hedging or directional speculative strategies, don't work well with the VIX derivative products. So UVXY, you can see overall has a downward bias. It doesn't behave the same way as the VIX itself does. So this is not an appropriate product really for hedging or you know, speculation as it relates to actual moves in the VIX itself. So I generally, you know, I tell our students, you know, focus on the VIX. There's just too many other ETFs that are, in my opinion, crappy products that track the VIX that really don't, you know, give us the same information or, you know, tell us anything valuable as it relates to market sentiment or market direction. So let's just focus on the VIX itself. I think that's you know, going to be. There is something though that I doubt this one's loaded in here. Let's see though. No. Let me get over to. There is something related to the VIX that is worth watching as we start to get into this type of strategy. And if you guys aren't familiar with this, let me get my chart up here. So there's some misleading things about the VIX and pricing. The way the VIX works is when you look at like VIX weekly options, they expire on Tuesday, but they're AM settled on Wednesday morning. And you don't actually see that settlement price on the VIX chart. So you might look at the VIX and be like, okay, what was the low of the VIX this year? Well, on January 4th, the low is 1634. That's a bit misleading because that may not have been the settlement price for the options. In fact, it probably wasn't. So there is a way to know what the actual settlement price is. And again, this is important as we get into future sessions, and we'll cover this more next week. VRO is the VIX option settlement index. So this is the way to see what the actual settlement price of the VIX was. I'm going to make this a line chart so you can see it. So here we can actually see what the VIX settlement price was. So I don't remember exactly what I just said. It was 16 and some change. But if you actually look at the settlement price that week, it was 1734. So the settlement actually was higher than the trade price, you know, the price on the VIX. So this is important to look at too, and it's important to know that as we, you know, look at the VIX and using it for strategy and market analysis, because you could look back on a VIX chart and be like, oh, the all-time low in the VIX was, you know, let's just say 8.25. I'm just throwing out a random number. So I'm going to base all my strategy and decision making on the fact the VIX does not drop below 8.25. Well, that would be not a good analysis or approach, because that number is not going to be the actual settlement price. Now, because the VIX is it's not like a stock. There's no shares of the VIX that you can trade, but you can trade options on the VIX, and they're European style. So there's no assignment. It's a cash settled index. So you could write puts on the VIX, and you can't get assigned shares of the VIX because there aren't any shares that trade on the VIX. So it's all cash settled, and it's European style. So why would it be important for me to know what the actual settlement price is versus what the chart tells me? Well, one, let's say we were selling puts on the VIX, thinking that 8.25 is the all-time low. That would be incorrect because you could actually, let's say the actual all-time low is 9.25, and you're selling a strike based on thinking that the all-time low is what showed on the chart. Well, you would have been incorrect, because you can actually, let's say you sold an 8.5 strike VIX put, and the close was 8.25. You could actually hold that through expiration, and it would be cash settled at 0 if the actual AM settlement price Wednesday morning was 9.25. So that'll become more clear. I'm just, again, trying to lay the groundwork. We'll cover that next week in more detail, but VRO is what you want to look at to know what the actual VIX settlement price is Wednesday morning. Yeah, and same thing with like VXN. Like, all these volatility products are, in my opinion, crap. They don't help us, analyze anything. They're most of them are worthless to trade as it relates to volatility. And as we saw, like with UVXY, they just tend to go down and down over time. So for those reasons and others, I stick purely with the VIX. Further away you get from accurate or real information by throwing in other variables that ETFs or ETNs are using to create a volatility product, the less accurate it becomes, and really the less valuable to me it becomes.
I got to say, Jeff, in 6 years, that's the first time I've ever heard you call an instrument crap.
There's a lot of them out there. I mean, there's a lot of leveraged ETFs out there, like SQQQ. Let me get back to let's just go out to like look at the SQQQ. It just goes into the ground over time. And this isn't completely accurate pricing because it goes through splits. Right, so a lot of these leveraged ETFs, because they reset every day and they're designed to provide a leveraged daily return as it relates to the index. So this would be like the Qs. But even for a long leveraged ETF, you get what's called beta slippage. So that's why like an ETF like SPXL, that's a triple leveraged version of the S&P, won't exactly mirror the S&P when it goes up and down because it's resetting every day. So there's a lot of them are crappy, but also there's a lot to understand about them. So a lot of people trade these not knowing a lot of the stuff and get themselves in trouble. So long story short, let's focus on the VIX. Let's go back to a 1-year chart. And we're going to look at skew in the VIX as it relates to volatility, as well as pricing. So little brief background here. So the VIX is kind of opposite of optionable equities. So generally with equities that are optionable, they have options that trade on them. You'll see the puts priced higher than the calls. There's a premium, on those because there's fear that a stock could drop. So for that, that fear and the demand to protect against drops in stocks, there's a premium put on put options. But the VIX, it's kind of opposite with the VIX. Put options tend to be less expensive because the market knows, the market makers know that volatility eventually reins in, it comes down, and the fear is on the move up in the VIX because it's inversely correlated. So when the market sells off, the VIX spikes, and that's where you would potentially look for insurance or protection is with call options, because the call option would be used for a move up in the VIX. And so for that reason, you're going to see call options generally priced higher than put options on the VIX. So like if we look at next week's expiration, and the calls are on this side, on the left side of the chain, and puts are on the right here. And we start looking at, premium. So here's our bid and our ask. Let's just take the nearest at the money strike. So at the 27 strike, we see an ask price on those call options at $1.90. But if we look at the ask price on the put side, it's $1.45. So it's less. Now that's kind of the opposite of what you'd see with an equity most of the time. So that's important information that we can use this pricing, and especially as we look across expirations, to tell us a story. Now there's something else we're going to look at, and that's implied volatility. So that's this column over here on the left on the call option side, and this column here on the put option side. So first, let's talk about what is skew. Well, there's skew can be analyzed in different ways. There's skew within expirations as it relates to implied volatility. So right now there's huge skew on the call side for puts. If you look at the at the money, or close to the at the money implied volatility on the VIX for next week's expiration, we have implied volatility of around 100%. But as we go further out of the money, look what happens to the implied volatility. It goes way up into the 300, 400%. So that's volatility skew. Now, we see a little bit of that on the put side, but not as extreme. Okay, so we're going to look at that, but also across future expirations. And then we're going to look at the pricing of near-term expirations versus further out expirations. And then I'll explain, what that tells us and what can be a very accurate way to determine whether VIX options are telling us that the market participants and option pricing models are expecting the market to move up or down. So that's what skew is. And as it relates to different expiration cycles, okay, so let's just look at, we're just going to look at the pricing skew first. All right, so if we take, we can kind of look at some of these in the money strikes, like the 27 strike, and we start going out further in expiration. Okay, so the ask at next week's expiration, those expire next Tuesday and settle Wednesday morning. And then if we go out to the following week's expiration, so these expired July 27th, let's compare the price at that strike. So this is the premium that market participants would pay for these call options. So again, think about what the call options are. They are most likely going to be used as hedging strategies, speculative analysis for the market selling off. So those are some of the ways that VIX call options would be used, and there's a lot of strategy can be built around those expectations that we'll again start covering next week. But for now, what we want to understand is that is the market, based on today, as we're running this analysis, is there more fear and expectation of a VIX spike, which would correlate to a market sell-off, or vice versa? And that's what skew can help us determine. So we saw that, and generally, with options, also think about this as it relates to time. Shorter term time frames, or time horizons, I should say, are much more predictable in general than long horizons. But not just predictability, just in terms of what could potentially happen. Well, a lot more can happen, in 30 days, within the next 30 days, than it can within the next 7 days, right? Because it's more time. There's just more time for things to happen. So generally, when you go further out in time, if there's the potential for more uncertainty, that creates more fear, and it raises the price of the option because implied volatility goes up. And look at implied volatility 14 days from now as it relates to 7 days from now at that 27 strike. It's at 108. And I think a week, the July 20th expiration a week from now was around 100. Okay, so there's volatility skew there. There's also pricing skew. But with VIX calls, when there's not a lot of fear in the market, and option pricing models are telling us that there's more likely to be a move up in the market, we generally won't see this extreme skew that we're seeing between July 20th and July 27th expirations that we're seeing right now. So again, the ask price, the price that you would buy these options at next week's expiration, was $1.90. But the ask going out to July 27th is there's $2.75. That's a huge skew, right? And this is just one strike price. We can analyze different strikes, but for now, I think it's best just to understand and analyze this at the money strike to get a feel for what this volatility and pricing skew is. So when I see, option pricing that's almost 50% higher going out to July 27th versus next week's expiration, July 20th, that's telling me there's a big premium on the skew going out 2 weeks, and there's higher risk of a move down in the market. So a lot of times what you'll see happen is the market's actually going up, is you'll see the opposite. So like if you and this is a mistake a lot of people make with VIX options. You know, if you were to sell calls or structure like a credit spread or something on VIX calls at one expiration, and it didn't, you know, the market didn't move up as you expected, and then, you know, between when you put the trade on and the expiration, let's say it stays flat or moves down, and then you're underwater on that position at expiration, and you go to roll the options out, but then the market's, you know, the option pricing models tell us that, you know, that sell-off may be over and the market's starting to move up. It would be difficult to roll those calls out in expiration for a net credit, because that whole scenario, that whole picture just changed. And that's how we know with a high degree of certainty that the market is, you know, likely to move up instead of down. So it's when we see this big skew in pricing between expirations. So near term pricing is much lower than further out expiration pricing, that the market is telling us that between, you know, now and July 27th, there's an expectation for a move down in the S&P. So not a guarantee, but really good to know. And so what kind of move down, you know, should we expect? Well, that's where implied move comes in. So the options market is implying a move up or down, and that's why you see a plus or minus here, of 3.86 points. Okay, so if, again, not set in stone, markets frequently move past expected moves or don't reach that expected move. But on average, over the long term, they're remarkably accurate. They can be highly inefficient short term, as you look at one example or two examples, but over the long term, it's highly efficient. So again, it's all about getting an edge in you know, long-term accuracy. So a 3.86 move to the upside or downside, good to know, right? Because as we looked at on the VIX chart, we can actually map that level, those levels out up and down, and keep an eye on them, you know, for support and resistance on the VIX as it relates to what's happening in the S&P. And if we do get a move down, let's say around the expected move of 3.86 points, and we start to see the S&P find support, and then the volatility skew tighten up so that the longer dated expirations are priced closer or even less than the shorter dated expirations, that's the shift that can help us navigate a potential bottom of a down move in the market and subsequent reversal and move up in the S&P. So it's a lot of information, a bit complex, but for now, we just need to understand what skew is, what it can, you know, what we can use to analyze it. In this case, both price and volatility, and how we can analyze it across expirations. Because you can get, again, as I mentioned, volatility skew within an expiration cycle. And there's a lot of it here, right? So implied volatility, huge volatility skew here as we move further out of the money, but also across expirations. So when I start to see a tightening of the skew, which would mean if I had bought, or let's say if I had sold calls at a near-term expiration, and all of a sudden I can't roll those calls out to a later expiration for a net credit for additional premium, when that happens, it tends to be followed by a move up in the S&P. And vice versa, when I start to see the skew widen and I see big gaps and higher prices in later dated, further out expiration calls at the same strike price as it relates to shorter dated expirations, that tells me there's more fear and uncertainty. And we tend to see a down movement in the S&P. So that's kind of how skew works and how we use it to analyze moves. And then, as I mentioned, as far as analyzing the actual move, we can't know that for certain, but that's where we can use expected move. And don't worry if you don't use Thinkorswim. All this information can be found on any options platform. So expected move can help me structure a strategy, to build a strategy or a trade around this information. And that's what we're going to get into in more detail next week. All right.
Yeah,
So
I was going to say, guys, this may seem like a lot, and you can, that's the beauty of being able to watch this, a couple times, and then maybe have some questions lined up. And then next week, when you go over the examples, people will be able to see it. But essentially, as you broke it down, you're teaching the public out there, like, how institutions kind of forecast what's going to happen in the market. I mean, this is like price action surgery. And what you're teaching is, I've never seen it done for options for the market, but I've read a lot of, books over the years, and Larry Williams, he's a legend. He has a book from like the 70s where he's talking about commodity trading, doing something very similar, looking at near-term pricing versus longer-term pricing to kind of see if there's going to be a jump in the market.
right.
And very similar. But I've never seen it done for options like this before. And I mean, it makes a ton of sense. Those of you out there who got a lot of experience, who may have heard something like this before, but not quite this detailed and as easy to follow. So yeah, I encourage everybody to watch it more than once. And then when you see some more examples next week, I think Jeff said it'll all kind of come together for you. It'll be something that you can use forever.
Yeah. And as we start to actually apply this to strategy and building a trade out of it, based on that information, it really will clear this whole, principle up. But for now, just understand, what skew is, how we interpret it, and how it actually is telling us what, this is how, as Richard mentioned, how institutions actually act on, a lot of their buying and selling in the market, assuming they're not Bernie Madoff or somebody who's trading on insider information or somebody. But if they're legitimately, buying and selling based on these things that I'm demonstrating, this is how they do it. And why it's so important is it's really the opposite of what most retail traders do. So when you see a lot of fear in the market and a lot of volatility skew on the call option side, then that skew shifts from being, from a positive pricing skew where further dated options are way out of whack. The premium's a lot higher than near dated options, and then that shifts. That's actually where you're going to see institutional buyers come in. But it's also, unfortunately, where a lot of retail traders are going to panic and start selling. Because remember, as I previously mentioned, unfortunately, most retail traders buy high and sell low. But we want to obviously buy low and sell high. And these are the things I'm kind of laying the groundwork to help us do that. And so just to kind of before we get into Ticker Roundtable, because we don't have a whole lot of time left, as we look at other expirations, so at this 27 strike, for instance, with a ask at 275, but then we go out another week, so there's still just 1 week. We see the skew tighten up. All right. So see how the ask is only at 290, but between the other two weekly expirations, it was what, like almost $1 difference. This is only 15 cents different. So the skew has tightened up between these expirations. So again, we'll get into what that means more next week, but as we start to apply this to strategy, but that's very important to know. I also see implied volatility is much less. So there's big volatility skew here, the 27 strike. It's lower than near-term volatility. So what that might tell me is there is expectation or fear of a potential near-term market sell-off, and once that subsides, there's a potential for a rebound. And so this isn't static information. We need to analyze it and reassess it periodically. But that's something also to keep in mind as we get into the building the trades around this next week is, as we look at different expiration cycles, we see a shift in the volatility skew going out to August 3rd. All right. So for now, just understand what volatility skew is. Do a little practice on your own and check out, look at the VIX options and look at the expected moves for each expiration cycle. Maybe draw some lines on your charts to see where the expectation is of a move up or down in the VIX. And then again, next week, we'll start kind of building some strategy around how to do this. And we're going to look at what's called a risk reversal trade. And I'll show you guys how you can put on a VIX trade for virtually no debit. I mean, sometimes you can even do it for a credit in your account or a very small debit, but often you just put this on for no money. So it doesn't hold any margin, or no money comes out of the account, and it can allow you to take advantage of VIX spikes, which again can be used for portfolio hedging. If you have a long bias in your portfolio, especially if you have a retirement account, a 401k or an IRA, and you want to protect those positions, and again also can be used for speculation, speculative directional trades. So again, we'll get into the building the trade next week, but for now, practice looking at volatility skew across expiration cycles, and then let us know if you guys have any questions in the meantime. So any questions to address now as it relates to that, Richard? And then we can get into our ticker roundtable.
Nothing on that. I don't know if you wanted to or had time to go back over I don't know if you looked at the 36 month moving average.
Oh, thanks for reminding me. Yep, I did forget to do that. So let's go back over. Okay, guys, so we're again closely monitoring the S&P as it relates to its 36 period moving average. And we've gone over the rationale for that over the past few weeks. And you can view those recordings in our YouTube channel. And you'll notice how accurately that served as support so far this month. The low, this is a monthly chart of the S&P 500. The low for the month is 3742.06. The 36-month moving average is 3737.48. Only a matter of around 5 points or less difference between the low of this month. So it's serving as very strong dynamic support right now, this 36 period moving average. We got a dip below it last month, but this is what we're watching for July as it relates to bullish or bearish market sentiment. If that level can hold, but I don't want to see a close like we have right now. This isn't obviously the monthly close since we're only about halfway through July, but I want to see a close near the high of the range. Right now, the high on the S&P this month is over 3,900, 39,1850. But also look, and I have the line right here. Here's our bear market territory. That's this red line you see here. That's a 20% move from the recent all-time high of 48,1862. So we'll again continue to follow up. But if the S&P closes this month above this 3850 level, and particularly if it gets closer to the high of the range for the month, whatever that ends up being, and we're no longer in bear market territory at the end of July, that's going to have very bullish implications, I think. Conversely, if we close below this period, 36 period moving average, bearish implications. So we'll continue to keep an eye on that. But thanks for reminding me. I almost forgot that.
Awesome.
All right. So let's take a few tickers. Anything you guys want to look at?
Yeah. Michael asked early on if you could look at AMD.
All right.
See, it looks like it's trying to hold at $75, but in a downtrend.
I think did we look at this last week?
I feel like we did.
All right. So I'll zoom in here momentarily. So from a zoomed out perspective, going back a couple years, you see a huge amount of support around the 60 level. Served prior resistance. So I just wanted to point that out, and then I'll zoom in here. Because right now the stock is trading at 76.36. And that's correct. There is draw that up a little bit higher. So a lot of support here, kind of right around 73. And as you guys know, like when we analyze these levels, like what happened in the past off this level. So previously, back in 2021, around March, May, we got a big move off this 73 zone up into looks like right around 165. Huge move up off that level. So this is strong support. And an important one to watch on AMD as far as how price reacts around it. If we start to get a move up, and this is where I then start looking at resistance, and we get through any significant resistance levels, I see a significant one at 80, and I'll zoom in, but you can see here. So this is my SR zone, my support resistance zone, between about 73 and 80. So for directional bias, I'm looking for a close, and ideally, 2 or 3 closes above 80 or below 73 for bullish or bearish directional bias, respectively. So me zoom in a little bit just so you can see that better. So that's what this 80 level here. To see how that, I drew that based on the past price action, but you can see how resistance was found right there. Looks like just early July. Then again, there's 70. But again, based on past support and resistance, kind of 70 to 73. Let's see what the low is today. Got some buying off of 70, around 74.50 today, which was the low, and then the close, of course, at 76.36. So those are the two levels I'd be watching: a break above 80 or below 73 to 70. And I like to use, the bigger round numbers. So 70, would be, and also being that that's the low from July 5th, roughly 71.60. This is the zone I would be watching for directional bias. And guys, you can use, again, AMD, Advanced Micro Devices, is an optionable stock. So a lot of what we're demonstrating with volatility skew and things can be used. It's again, would work on the put, you'd be looking at it on the put side here, but can be used with stocks as well, not just the VIX. So a lot of the stuff that we're going to be building strategy around and structuring trades can be applied to other products, not just the VIX. So those are the levels I would watch, and then do my volatility skew analysis and look at the option pricing, the expected moves, etc., and then kind of go through that whole top-down approach.
All righty. Ed wants to see CORT.
CORT. Is that Corcept Therapeutics?
Let's see if you know it.
I got it. All right. Let's see. Corcept. It's a biopharmaceutical stock. So we had a trade trend sell yesterday, triggered today. But I see a lot of strong support here. Looks like right around the 26 level. So that's the level I'd really be watching near term. You can see how strong that level was for resistance back in March and April. The other level I would watch as it relates to support, it's around 24. Again, a lot of resistance there in prior months. But as of now, the stock is going to move up, and it did break through this resistance zone last month. So that's bullish for Corcept. Had some indecision today, which indecision because the open and close on the day were relatively close together as it relates to the range from today. And so when I see indecision around a major level, that can often be a good thing because especially on a bullish close, because we closed higher on the day and a lot higher off the low. And so if this 26 level can hold and we start to get a move up off and maybe even above the high from today, then my bullish, or my bias is bullish. And if we get a close below support, that would shift. But this is looking like a potential bullish opportunity. And if I'm using trade trend, I want to be looking for buy signals. We talked about the divergence, trading divergence last week in the divergence cloud, which currently there's no bullish or bearish cloud, but definitely bullish price action, broken through major resistance, came down and retested. So I'd be looking for, if I were trading this, for this 26 level to hold, and then some follow through back to the upside. Because let me zoom out here a little bit. So there's not a whole lot of resistance till up around 31. So it's got some room to run on a technical basis. All right, let's take one more.
Let's see if they can get this one. This is a hard one. GOOG.
That's a hard one.
Trying to stump you.
All right, so it's just a really like choppy, volatile stock. Alphabet, it's I don't do a lot of trading or any really in this name, but it's been ranging a lot, obviously, and currently has rejected the top of the range up here, kind of around 2,400, bottoms around 2125. So to me, this is kind of a ranging play with a pretty wide, over almost a 300 point wide range. So it's always important, to as you're drawing your levels, to first, paint the picture, tell yourself the story of what the stock's behavior is. Is it, trending? Is it ranging? Is it, what is it doing as it relates to these levels? And right now it's ranging between, roughly 2125 and 2400. And then where is price currently as it relates to that range, and what has it done off of those levels? And so those are the questions I ask myself. It's, it hit the top of this range, is retreating off of that resistance area. So lots of things can happen within a range, and that's why it's important to continue to look for other levels. I see an actually very strong one right around 2240, 2250 that I'd be keeping an eye on for support potentially, considering this parabolic move off that level to the upside. So tricky price action to trade when you see these a lot of volatility. You're seeing very wide intraday ranges, right? And not a lot of directional, clear directional movement on the stock. So pretty tricky, but overall, this is looking, fairly bearish, but to make a more of a bullish case, I'd want to see a sustained break above the high of the range around 2400, or for a bullish case. Bearish case, I'd be looking for sustained break below the low of this range around 22. Just call it 2080 to 2125 zone. So kind of in the middle. A lot of stuff kind of stuck in the middle of these significant levels, even as we dig down and drill down into individual names, due to the fact that the major indices are in that territory. So that's why, even if you're trading an individual name like Google or AMD or Corcept that we looked at tonight, very helpful to do the high level analysis on the major indices first, and then see how things reside with the individual stock. as it relates to what the broader market's doing. That way we're kind of, we're trading with, with the flow. So we're not trying to swim against the current there. All right. Those are good suggestions. Thanks guys for suggesting those. And we'll take a look at it more next week, obviously. But I hope you guys can attend next week because, again, a lot of more strategy, to cover there. We're going to really drill down into actual, structuring a trade, building the trade out around volatility skew. And again, even if you don't trade options, I think it'll be very valuable. And I'll show you guys how you can use this type of trade for hedging, for portfolio protection. And by the way, a lot of hedge funds use this type of trade, this risk reversal trade, to hedge their hedge fund portfolios. And it's also a great way to speculate on market sell-offs or volatility spikes. So again, get into that, all the details next week. Any other questions to wrap up, Richard?
No, that's all for now.
All for now. All right, guys. Well, keep an eye on all those levels, especially for tomorrow. Again, CPI comes out tomorrow for June. And watch the 3800, 3850 zone tomorrow for support and resistance. That's going to, I think, give us a lot of good information and insight into potential market direction for the rest of this week and into the coming weeks. Keep an eye on that 36-month moving average on the major indices. And we'll see you guys all next Tuesday.